So we see here what I've called the most important head and shoulders top in the history of the financial world, I believe. You can see here, shoulder, head, shoulder, 319,838 ounces. So we had a little bit of a gold outflow. And when they figure that out, they're going to start dumping stocks and going into gold because the dollar is going to be in free fall. Gold to S&P 500 ratio is at a critical juncture, a juncture that goes back about 15 years, a pivot point, and I'll show you the most important head and shoulders top pattern in financial history. That is the gold to S&P 500 ratio. That ratio is still below where it was in 1971, which means that gold has outperformed the S&P 500 since 1971, which means that all of the gains in stocks in general have been an illusion for the last 50 years, which is what inflation is. It's an illusion. And when that illusion evaporates, you have the end game, which is coming fast. Once silver does hit a 15-to-1 ratio, I believe it will stay there this time for a respectable amount of time, maybe a few months, maybe a year or two, not exactly at 15-to-1, but it should descend to between 30-to-1 and 15-to-1 for a respectable amount of time. And in that time, silver mines are going to be taken over by bigger players with the capital to develop them. So the point of investing in silver explorers now is to get a cheap speculative supply of silver in the ground on the assumption that when the ratio hits between 30 and 15-to-1 in an endgame scenario, that these companies will be acquired by players with huge amounts of capital and they will be put into production. So you buy basically a call option on silver now, expecting that it will be developed in an endgame scenario, which is inevitable anyway. First chart we have today is the outstanding T-bill supply. It has peaked out at about 6-point-something trillion dollars, and this will stay steady to falling until we get a debt ceiling raise. The reason that I'm showing you this chart is because of the next chart. You can see here, this is since 2014, so you can see on the next slide how it goes in parallel with money market funds. This is the extra dollars that are mostly bank reserves, where they are invested in the money market. So the money market is basically reverse repos plus T-bills. That's where money markets invest their funds for a little bit of interest. So if you have fewer T-bills, you have to have more reverse repos. So we see here that on the bottom here, we have the T-bills outstanding. On the top here, we have the total amount of money market funds, and they are at about the same number, 6-point-something trillion dollars. This goes to Q1 2024, and this goes to Q3 2023, but they're basically the same number. And so the effect of this, and this is what Daniel Oliver predicted 2 months ago in his research report that I will put a link to in the bottom of the description below. You have here the overnight reverse repurchase agreements, the ONRRP, reverse repos, as we call them. And we can see here that we are now at 130 billion, 129 billion. That is higher than the minimum we were at on February 14th of 58 billion. So it's gone up about $70 billion since then. You can see here, this was the end of month spike on February 28th, and you have end of month spikes typically every month. But after that, they quickly fall down to a new low. But this time, we seem to be hovering at around $70 billion higher. And this is what Daniel Oliver of Murmacan Capital, my favorite gold and silver analyst in the world. This is what he predicted 2 months ago. He said here of Bessent, Treasury Secretary Bessent reverts to standard Treasury practice, issuing only 15 to 20% in bills, short-term debt meaning. The 10-year financing reference rate will drift higher, and a falling short-term rate risks enticing money back into the Fed's reverse repo facility, sending a tightening shock through markets and the economy. Well, it appears to be this is finally happening now. He was about 2 months early, or not really early. He did it on time. 2 months is pretty much on time. I think that reverse repos will start to build here as the Treasury bill supply starts to fall, and that will have a tightening effect on bank reserves. And this is why that's important. You can see here that in the red line, we have the other factors draining reserve balances. That means the reserve balances in the Federal Reserve System, in the banking system. They are supposed to go up as the Treasury's account, the Treasury's bank account, goes down. Now, over the past 3 weeks, we've had a drain of the Treasury's bank account of $280 billion Now that should all go into bank reserves. As the money comes out of the Treasury's bank account, it has to go into the banking system, and most of it will be taken up by bank reserves. However, bank reserves are only up $92 billion since the drain of $280 billion from the Treasury's bank account. Why is that? Well, because the reverse repos are starting to rebuild, and that is outside of bank reserves, outside of the banking system, because there's nowhere else to put this money. So basically what I'm saying is that bank reserves are going to stay steady here, more or less, until the debt ceiling is raised. If they stay steady, that seems to be balancing for the plumbing system. However, in that time period, the secured overnight financing volume, basically the repo volume, is going up and up and up and up. We are now at $2.684 trillion as of February 28th, 2025. I think we're at like 25 now, or maybe $100 billion less, but it keeps trending higher. It is not going to stop until it takes up the critical amount of bank reserves, and that we see in this next chart. This was the last repocalypse, Wednesday, September 18th, 2019. This is the repos to reserves ratio, how much of bank reserves are taken up by these overnight repo trades. And September 18th, 2019, it was 83.479%. We are now at 78.27% and trending higher. We've got about 5 percentage points left until we hit the repocalypse ratio. We are going to hit it because repo volumes will continue to trend higher, will cause a clog, and it is coming shortly. Now, these sentences show why Keynesianism, this is from an article in Bloomberg, and I'll put the link in the description below, why Keynesianism is so stupid in 5 sentences. Let's read it together. This January flurry of imports was broad. It's talking about the imports, the U.S. trade deficit, right? For February, or January, actually. The January flurry of imports was broad and included a surge in inbound shipments of industrial supplies and materials. Within that category, imports of finished metal shapes that include gold bullion jumped $20.5 billion, marking a second month of steep increases. So what? Much of that increase in gold imports came from Switzerland, not London. Switzerland, where the U.S. trade deficit widened sharply. The nearly $23 billion gap during the month was second only to China. Goods and services trade, excluding the impact of gold imports, this is the key, this is why Keynesianism is so dumb, may weigh on first quarter gross domestic product after contributing slightly to the growth in the closing months of 2024. So basically they're saying, Bloomberg is complaining that higher gold imports from Switzerland are going to put a damper on GDP, which, you know, the number is going to be lower because if you count imports against GDP, which is how GDP is calculated, well, it looks like your economy is slowing down because you're importing all this gold into it, which makes absolutely no sense. The gold inflow into the COMEX has paused for the first time since it began in January. We see here that the change in this low number over here, it says 319,838 ounces. Up in registered, but down 327,605 ounces. So we had a little bit of a gold outflow from the COMEX vaults in gold yesterday. First time these supplies have started to level off at around the all-time record high of just below 40 million. So we've matched that record high. But in silver, the flows continue. We're now at 420 million ounces, which is an all-time record high. Appreciably above the just under 400 million ounces high in 2021 around silver squeeze. The action now really is in silver, but the price action is in gold. The physical action is in silver. And I wanted to go into the long-term gold to S&P 500 ratio. This isn't actually long-term, this is medium-term. But you can see here, we are in a giant pivot point over here. You can see this point of 0.512 has been hit about, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times since 2021, it looks like. You can count it in many different ways. Let's say 10. This is also a pivot point going back to 2019 and 2017. You see here the circle here, and it was a support zone in 2016, and also it was back in 2006. It was a resistance zone, and the breakthrough happened in 2008. Once this support zone breaks, and yes, it broke over here in March, but that was a special circumstance from the lockdowns. That is not anywhere near normal, so we're just going to scratch that because the world had lost its mind over here. The line breaks over here, and we start to appreciably trade above it. People are going to start panicking and seeing that their stock portfolios are not outperforming actual money, and they're actually losing money because the ratio is going higher and higher. And when they figure that out, they're going to start dumping stocks and going into gold because the dollar is going to be in free free fall. So we see here what I've called the most important head and shoulders top in the history of the financial world, I believe. You can see here, shoulder, head, shoulder. This is the long-term S&P 500 to gold ratio, or rather, yes, S&P 500 to gold ratio. We can see here that the shoulder here in 1971 is just about the shoulder here in 2022, and we are now below where we were in 1971, which means gold has outperformed the S&P 500 since 1971, meaning it's all an inflationary illusion. Here is the head, and here, over here in 1980, when we reached a low in the ratio, that is endgame.